Proud supporters of Africa this week. Engine, with us, you are number one.
The Nigerian Economic Forum, which has just begun in Johannesburg, South Africa, presents high-level information and networking opportunity for investors and businesses with interests in one of Africa's largest markets, Nigeria. And the headline speaker was Oscar Onyema, CEO of the Nigerian Stock Exchange.
I think the key issues we've seen is really investor confidence and the lack of liquidity and depth in the marketplace. So our key priorities are really to help bring back investor confidence in the marketplace, introduce measures that will deepen the market, and then also roll out new products to allow for diversity of products.
Investors have really been fence-sitting, some would argue. You know, despite all the reforms that have been taken concerning the banks, AMCON to inject liquidity, processes now to recapitalize those banks, introducing governance procedures, financial reporting rules, people are still not sure how to treat Nigeria. Why is that?
I think there's a lot of excitement about Nigeria and the Nigerian capital markets. And like you rightly pointed out, a lot of the institutional investors are sitting on the sidelines because of the uncertainty surrounding the resolution of the banking crisis. We believe that with the action that was recently taken by CBN, NDIC, and AMCON, that we should begin to see some closure to the banking crisis. And so you will see certainty coming back into the market, and that should really help to drive investors back into the equity markets.
What the banking crisis has demonstrated is the fact that the index is heavily weighted towards financial institutions, and there are calls that please try to get new listings and try to get them from new sectors, such as telecoms, for instance. Start to get property investors coming to the market to raise funds. What are you doing in that regard?
You know, if you look at the distribution today, banking is 36% of the pie. And then building materials is another 16%, and breweries and food and beverages account for 12% each. So we need diversification, and we're looking to certain areas: telecom, oil and gas, upstream oil and gas, utility, and agriculture, which accounts for about 32% of our GDP.
How exciting do you expect things to be? Because you talk about utilities, and we know that the government has embarked on a very aggressive power sector reform drive. We're also anticipating, hopefully, conclusion of the petroleum industry bill, new entities coming to the fore. How's the market going to support these reforms?
We're excited about these reforms because with power, for example, you have about 18 new companies that potentially will be coming to market. With the PIB bill, you have the potential to bring NMPC or some variant of it to market. The joint venture alliances that we have with various multinationals, there's a potential there to bring them to market. So there's huge potential, and as you know, a significant portion of our market is driven by foreign investors. So they're also watching keenly to see what happens here.
South Africa's nearly 100-year-old land bank has reported that its recapitalization and improved management processes have produced a stable institution that inspires better investor confidence. Pagamani Hadebe, CEO of South Africa's land bank, explained.
It is a difficult space, but again, just like any other sector in the financial market, we are facing exactly the same problems. The margins are tightening, and non-performing loans are growing, impairments are growing. But Loretta, I must say that the land bank has done exceptionally well. We've been able to build the book. We grew the book by 16%. It's not just growing the book, that's a loan book, but we've improved the quality. That is, we've been able to reduce non-performing loans and impairments. So we are one of the very few institutions that have been able to do so.
Going forward, I mean, I think the big challenge is to make the land bank commercially viable. You've had a torrid financial history. The government had to come in with some sort of a bailout or recapitalization. And the issue is, as you're growing your loan book, as you're reducing that ratio of non-performing loans, you've also got to create a sound, commercially viable institution. How are you grappling with all these challenges?
We have done very well during the past 3 years. You know, the bank up until 2009 was going down the drain. Now it had 5 years of qualification, and it had made losses up until 2009. Thereafter, it was transferred to the National Treasury, and we needed to turn it around. And since then, from 2010, 9, 10, 11, we've been making a profit, which means that we've put appropriate fundamentals to ensure that the institutions survive. Importantly, though, is that we've put in what we call a sustainable business model that will allow us to move forward. What does it mean? The first thing it meant was you get investors to come back and lend you money so that you can on-lend. Investors had left. Since then, they've come back, and when they come back, then they reduce the cost of borrowing. The second thing is the bank was facing huge non-performing loans. We've been able to reduce that by about 35% over the past 3 years. That's the second thing. But thirdly, it's the ability of the bank to get the people with appropriate qualifications and experience that will be able to steer the institution to the right direction. So the worst is over. And actually, the minister did indicate last year that the turnaround has been completed. Now we're back to the core business of the bank.
Risk management systems that you've introduced, because you're talking about the need to continue to reduce impairments and non-performing loans. This becomes a problem to those who are debtors, because there is a sense that when you're lending to the agricultural sector, you know, there's a big risk in the process of land acquisition itself, and then there's the incumbent risk of the farming activity, and you've got to mitigate somewhere along the line. And when we're seeing commodity prices fluctuate or drought conditions permeate, or the economic recovery being sluggish and banks not lending, that has a direct bearing on the work that you do.
It does have a bearing, just like any other bank. But if you're looking at the land bank book, a loan book, you can separate it into two forms. There's a commercial side, about 75% or so. Then there's a development side. The commercial side has been doing exceptionally well with non-performing loans of about 6% or so. What we have done then is to go to government and say, government, for us to get into the development side, you'll have to come and assist us. That is, you'll have to recapitalize and assist us, because the gearing of the clients we have in this arm of the market is too high. That is why we've been able then to sustain the business as we move forward.
The International Finance Corporation has announced its results for the fiscal year ending 30th June 2011. Of the 95 new investments made during the last fiscal year, 87 were in the world's lowest income economies, where the IFC's development impact is especially profound. We spoke to Jean-Philippe Prosper, Director for Eastern and Southern Africa at IFC.
We have done it because the opportunities are there and we have the people on the ground. You may know that for the past 5 years, we have been ramping our activities significantly in sub-Saharan Africa. In 2003, for example, we did about $140 million only, but for the past 2 years, we have gone over $2 billion.
All right, now the focus tends to be on low-income economies. Why these particular countries? What do they have to offer?
Well, those are the countries that need us most in the first place. You may recall that IFC, we are part of the World Bank Group and we're a development institution. So our raison d'etre is really to help development, and we do it through the private sector. So we put a special emphasis on those low-income countries. And I have to say that Africa is a key priority for IFC and for the World Bank Group for that matter.
Well, in that respect, a lot of work has been done, it seems, in West Africa, where your commitments have increased 8.5%. What makes the region exciting?
It's really, as I said, the opportunities that have come up with improvement that we have seen in the economies in Africa in general. You have seen we have less conflict, we have improved macroeconomic environment. And so this attracts investors, and this gives us more opportunities. In addition to that, as I mentioned earlier, IFC has upped its own game. Today we have offices in Africa in general in, I would say, more than 19 offices, and we have more than 400 people in the ground. So this is reflected throughout, actually, sub-Saharan Africa. We have invested this year in 31 countries, by the way. So West Africa is just part of it. We have done a lot in East Africa, in particular, where we have had our best year ever.
To help its clients on investing in Africa, South Africa's Rand Merchant Bank is launching one of the most comprehensive documents on the subject, Where to Invest in Africa, which analyzes all 45 countries in sub-Saharan Africa. Celeste Valkenier is a Rand Merchant Bank's Africa analyst.
Well, it's actually difficult to just tell your client these are the places you should go, because our clients are very diverse. They look at different sectors. So the document tries to tell each client which sector they work in, which countries that we suggest. It's only a suggestion, but it's also just to make our clients aware of, do not just look at the overall aspects such as growth, inflation, just macroeconomic aspects. Also look at the operating environment of these countries.
We know that for a lot of investors coming into the continent, it's really a commodities play, mining, oil and gas. Those seem to be the sexy areas of investments. Where else can they go?
You're right, it's still the sexy environments, and we do still see resources being the game player for at least the next decade to come. Other aspects we can look at is consumption. Domestic demand is increasing significantly in sub-Saharan Africa. If you look at East Africa, especially Kenya, Tanzania, Uganda, you can see consumption increasing there. Growth in GDP per capita, growth in population, all those aspects just show you that consumption or retailers have got a nice and improved environment to go and invest in.
Estimated growth rates of 5.6%, give or take. How would that be an influencing variable?
Well, I think definitely growth should be one of your strong variables that you look at for your economies. But we must also remember there are some countries that experience strong growth rates over the past few years, mainly because some countries actually came out of civil wars or starting to build their infrastructure. So looking at just growth is dangerous. Maybe looking at our forecasts for growth for at least the next 5 or 10 years would be a good indication to see where growth is going to lead these economies. But also not to forget to look at other aspects such as market size, how many people are there, the business environment, all those aspects we try and look at in this document.
What pervasive risks exist? Because obviously you've spoken about the buoyant growth in the consumer class, spending power of Africans. You are talking about the commodities issue and the macroeconomic environment. What other variables need to be considered? We've just had this conversation with the lady at Fitch, and exchange rate volatility is something that many investors are concerned about, whether or not they should be going into dollarized economies or not. What other variables?
Exactly. There are lots of variables you can look at. If you are a resources sector industry and you want to go and invest in resources, obviously your first thing you should look at is your exchange controls. What type of controls do they have with actually creating a business, getting licenses? What are your taxes? There are so many variables to look at. One of the main ones also to look at is what type of policies your government that you are going to invest in have adopted. But we see that the reforms in most of these countries, and a good one to point out is Rwanda, significant reforms we've seen over the past few years. So those are the countries these companies rather should focus on.
Investing in an emerging economy is challenging, but if done right, it's a way of making significant money while also making a direct and profound difference to the lives of ordinary people. That is the view of private equity investor William Jimison, founder and executive director of Musa Capital.
The increasing appetite for African investment as a primary destination for diversification purposes is at an all-time high. We've been doing business on the continent for over 20 years now, and as we heard from your earlier guest, to have a firm like R&B actually put resources together to focus on an Africa report is indicative of the opportunity upcontinent.
I mean, the reason I'm asking you this is because we're told that private equity flows have increased above $2 billion or so per annum, but the concentration tended to be North Africa and not sub-Saharan Africa. Is that changing? It
continues to be the case. Looking alone at South Africa, there's currently about 97 billion rand under management in private equity in South Africa. About 31 billion of that is still what we call dry powder or available to invest. That's South Africa. If you exclude North Africa, Egypt, and so forth, maybe a tenth of that number is available for the rest of the continent. You look at economies like Nigeria, with a population over 150 million people, you wonder to yourself, is the need being met from the amount of liquidity in the market that's there now? And the answer is no, absolutely, which is an opportunity.
Now, private equity tends to focus on deals that are above 50 million, but we keep on hearing that actually the focus for Africa needs to be investment in SMEs. In fact, a report came out in Ghana that, despite Tullows listing and that boosting market capitalization, the only thing that will make that exchange dynamic is if SMEs list. But it seems to be the one area where investors fear to tread. Why is that?
It is the highest area of risk for investment. I mean, one out of every 7 businesses that start end up making it to be a mid-cap business and then going on to be a large cap. So there's a tremendous amount of startup risk related to that local operation to get it right early on, which it requires a very specialized investment skill that isn't necessarily as prevalent on the continent as it is in some other markets. To date, private equity remains a dominant asset class, primarily by the U.S. Globally, last year, about $55 billion was raised in the United States for private equity. In Africa, $1 billion. Yeah. So it should give you some context of not only the lack of capital that's available, but also the lack of skill set.
Okay, so Musa, you're prepared to go where others fear to tread, and that's within the mid-cap, not quite small, but somewhere medium enterprises. Why is that?
That's where the opportunity is. As the statistics that we just discussed, the question we often are asked as private equity fund managers, I'd be asked this if I work for Brait or an Ethos or for KKR or Blackstone, is where do you find transactions? Where's your source of deal flow? And more often than not, in the United States, you find cases where you have a large amount of capital chasing a very small pool of investment opportunities, driving up valuations, et cetera. Why do we go where we go into the mid-cap space? Is because often we are the only source of capital available. What is interesting about our model is that we go in early, not to be by ourselves.
After the break, more stories making headlines this week.